Are you a small business owner looking to maximize your cash flow? In this video, I'm going to take you through an example of an actual business to show you what the only three levers are that you have in your business to maximize your cash flow so you can sleep at night knowing that you're going to be able to pay all your bills as well as pay yourself. Welcome back, or if this is your first time to my channel, welcome. My name is Brad Flynn and I'm the Profit and Loss Coach, where I help business owners like you to easily understand the numbers in your business and make more money. Now, the easiest way to think about your cash flow is like a bathtub. Yes, a bathtub. Water coming in, which in your business is cash coming in, and then you've got water going out, which is pulling the plug and cash going out. What we want to do is regulate the in and the out such that we keep the bathtub level at a certain comfortable level for us. And that's where our three levers come in. The first one is our accounts receivable. It's the money that is owed to us by the people we've already supplied our goods or services to, and we're waiting for them to pay back to us. So what are some of the ways that we can actually pull on this lever to get our bathtub level rising to a point where we're comfortable? The first thing is the timing of our invoices. As soon as we complete a particular job or a project for a customer, get that invoice out. The sooner we can get it out, the faster we can get the money in. Now, if you're having trouble do that, you can either get someone in your business to do it or maybe even outsource it. Another great way to pull on this lever is stop dealing with the bad payers. You know the ones that I'm talking about, the ones that seem to take forever and ever, and you've always got to be hassling them to get that money in. Sack them, get rid of them. They're a pain in the neck and they're costing you money. Depending on your business, get a deposit when you start with a new client. Get the money from their account into your account rather than waiting over in their business before you get started with them. Ask for a deposit to get things moving, to get your bathtub level to go up a bit and make you feel a bit more comfortable. The key thing is with accounts receivable is the squeaky wheel gets the oil. So what sort of a squeaky wheel system do you have? How often are you going back and following up some of your overdue invoices so that you can get the money from their account into your account or your bathtub? The second lever we've got in our business is our accounts payable lever. The money we owe to the people who have helped us out, our suppliers and employees and those sorts of things. Now, can't do much with the rate you pay your employees because they're on a fixed wage. But what we can do with our suppliers is negotiate some new terms. If they're not prepared to give you better terms, and what we're looking to do here is extend out how long we take to pay these people. Not in a bad way, we've still got to get it right, but what can we do to make sure that we're extending that out so that we can keep the money in our bank account or our bathtub for longer? If they say there's nothing you can do, the best question you can ask these guys is, just hypothetically, what would we need to do to get better trading terms with you guys? Sometimes it might be as easy as buying all your equipment or supplies from that one person as opposed to having multiple people that you deal with. But in the very least, ask the question. Our final lever is our inventory. Inventory sitting on our shelves is like cash, dead cash sitting on our shelves. We can't flow it in our business. It's sitting there stagnating. So what we want to be looking at is how do we reduce our inventory levels? How do we carry less? Because like I said, there's money sitting on the shelf. And what about if you were only to take inventory on consignment? You only pay for it once you use it. That way you're going to speed things up and keep the money in your bank account longer and not wasting on your shelf. So now we've looked at our three examples. Let's put some actual figures into an example using one of the tools that I use with my client to help them get their bathtub level to rise. So let's say we've got a business, and this is taken from a business balance sheet. Cash in the bank, $20,000. They've got $30,000 worth of inventory sitting on the shelves. They've got accounts receivable of $50,000. In other words, they're owed $50,000. They've got PPE, property, plant, and equipment of $80,000, and they owe $18,000. Now, what that means is, on average, their receivable days, or how long it's taking them to get paid, is 37. Their payable days, how long they're paying their bill, how quickly they're paying their bill, and their inventory days is how long on average it takes them to turn over the stock that they have. So we're going to pull these levers, receivable days, payable days, and inventory days, and watch what happens. So what this looks like in reality is we've got our orange section here. So day one, we get our order. Okay, so when we first start, this is where we get our first order, day zero. And then we're progressing along. Now, on average, it's taking us 48 days to turn our inventory into something we can sell. So at this point here, but guess what? We've actually had to pay a bill at the end of 30 days like we do. So in this instance here, we're paying on average at 29 days. Now, what happens is we may not get that job finished till right up the back here, and then we start to invoice. So even then, if we finish it somewhere in here, our receivable days, we might invoice it here, but we may not get paid until the end here. So the money doesn't actually hit our bank account. So what we've actually got to do, we've paid for it for here, and yet we've still got to finance this bit in here until we get paid by the customer. Now, in this example, what it means for this particular business is an extra $38,000 that they have to actually finance. Now, that's a lot of money. It's taking 86 days from the time they get their order until they get the money in the bank. So we want to speed that up. So here's how we do it. Let's say by using those strategies we've talked about, we're able to lengthen out our receivable days. So I shorten up our receivable days to 30. So now we're getting the money in a lot quicker. And our inventory days, we're getting products out the door faster. That's an extra 35 days down from 48. Our payable days, we've gone back, we've negotiated with our supplier, and we're now able to pay out to 35 days. So that's shortened our cash gap day from 57 down to 30. So what that means is we've got an extra 18 grand in our bank account instead of out in our customers or our inventory bank account. Hopefully you've enjoyed the video. I've got a bunch of ideas to help you with maximizing your cash flow in your business. Subscribe to my channel up here. If you're interested in having a look at that cash flow analysis for your business, you can book a time down below. Look forward to catching you on the next video where I'm going to help you make some more money.